on about like an old man, don't like change. Things were better in the old days, that kind of stuff. All right. Clay can hear me, thank you. Okay, so let's see, now we'll move on to the visual part of our presentation, see how that goes. When you can see that, we can get the ball rolling on this thing. Andrew says I sound good. That's not something no one's ever said about my singing. And we can do the screen now. Thank you guys. I appreciate your participation. Uh-oh, can't, there it goes. Couldn't close that little screen. Wow, look at the NASDAQ, 1.5%, very nice. 15,200, S&P 4444. That's a lot of fours. And then the Dow is 34,500, actually lagging the other indexes. And the Russell is having a good day, but still 1876, not too impressive. Apple checking in is still, look at how Apple's like coming back off that bottom there. Gold, 1950, nice. Oil, 79, boo, but at least it's not 80, but you know, we're coming into the holiday weekend next week. So what happens before a holiday weekend in oil? Oh, we should check the report. Obviously, the report wasn't that bad because oil picked up. Or, well, you never know, right? So the reactions to the oil reports are so stupid, who can tell what it's going to do? So what happens into a holiday weekend? Well, assume there's X% of people go somewhere on the holiday weekend, right? A lot, though. Oh, that's a good question. Let's see who knows this. Is Claude going to know this? Is ChatGPT going to know this? Where's Bing? Bing, I got to open up the Microsoft Edge. All right. So, compared to a typical weekend, how much more driving is done on what's coming up, Memorial Day or Labor Day? Uh-oh. When it's Memorial Day, right? When is Memorial Day? May, oh no, it's Labor Day coming up. Silly me, all right. Labor. So, how much more driving is done on the Labor Day weekend? La-di-da. See, I love this because I have these notions all the time. This is why I love AI, because I have these notions all the time, and I'm curious, but I'm not curious enough to sit there and look at 35 articles trying to figure it out. This thing, although maybe inaccurate, can give me a pretty good idea of what's going on. So, Americans took 2.8 billion fewer total trips during the Labor Day weekend in 2020 than did in 2019. That's not what I asked. 38. However, the same period also reported long-distance travel. It is not clear how much more driving is done on Labor Day compared to a typical weekend, as the data sources found do not provide a direct comparison. However, based on the information above, it seems that the driving patterns, depending on the year, oh, come on. Oh, nope, see, COVID strikes again and screws it up. Okay, now we'll see if it gets mad at me. Yes. Oh, man. Yes, but it's 2023, August 23rd. So let's not use COVID impacted statistics and get your best guess on how the holiday weekends compare to quote normal weekends. Yeah, of course he can't find reliable data yet. It's not that day. It's not Labor Day yet. Oh, he knows that. Okay. He's still historical trends, current data. There you go. Labor Day weekend is busiest travel periods of the year, along with Memorial Day. In 2019, before COVID, AA estimates 43 Americans would travel by car related. There was a 4.3 increase. That means 13% of the population. In comparison, a normal weekend saw 28.6. There you go. We got the answer. That's a big number, 28.6 to 42.3. So that's 30 to 42 is 12 out of 30 is 40% more. See, there's the answer. And you know what's funny? Like, you guys ask me a question in chat, and I do all that, and then I say, yeah, there's a lot of driving, or I'll say, yeah, there's 40% more driving. But that's how long it takes me to come up with that answer, to just say, okay. So, I thought I turned you off. Okay. Oh, where are we? Oh, yeah. So, what were we talking about? We were talking about oil, and we were talking about usage. So what I was saying, yes, so there will be 40% more gasoline consumption this weekend than a normal weekend. Therefore, 40% more cars are going to fill up. Now, gasoline as a percentage of our total fuel consumption is about a third of all fuel consumption is gasoline, something in that neighborhood. So, you know, if you are increasing 1/3 by 40%, that's going to be a 12% bump in total fuel. That's not at all insignificant. That's 2 million barrels. I'm sorry, it's 12%, I say. So it's like 3 million barrels a day of additional consumption during this weekend. So for this weekend next, basically, because 43 million cars is 40% more cars are going to be fueling up this week and next week. So they're going to, you know, either coming and going. So it starts next week when people fill up before the holiday, and then on the way back, they need to fill up again at some point. So you have 2 very heavy weeks of consumption, and that generally is a good time to bet that that gasoline and oil are going to go up. So at the moment, we're down below 79. It's interesting. It went up early. We had, where's the other chart? See, there are some things that are so macro that you can count on them, essentially. And this is one of the greatest things that you can count on. It's just strictly math. I mean, people are going to fill up their tanks. They are going to consume more fuel. The trick is figuring out when it's taken into account. What happened here is, as I said last week, and I said last week that we weren't, or 2 weeks ago, whatever it was. Well, what date was it? The 11th, and it is now the 20-something. So yeah, 2 weeks ago. So 2 weeks ago, we had this discussion, and oil was testing 85. And I said, well, I wish I had the balls to short it, but you're coming into the holiday. It's not a good time to short it. It's too scary. And I said for sure, if it's $85 at the holiday or after the holiday, I'm going to short the shit out of it. But instead, it fell off early. Because the only reason we're up like this was because of the holiday, and then post-holiday, it's terrible because you have this holiday is the beginning of September. Then you don't have anything really until October. October is Halloween. That's not really that's a stay-at-home holiday more than anything else. And then all the way till November until you have Thanksgiving. And Thanksgiving is also kind of a stay-at-home holiday. This is the last big driving holiday, really. It's different now. See, now Christmas is more of a jet fuel holiday. You know, a lot of people fly on Christmas, but that, or in that time period between Christmas and New Year's, but that's not it. But jet fuel isn't a huge portion of consumption. So the best time to play the market for gasoline, whatever is now. So Then we go to the EIA report. So now we have a premise that oil should be heading up. So now we go to the EIA report and we see what nonsense that's going on over there. So petroleum status report, which was out at 10:30. So once we're full of useless statistics, we start taking a look at the report. So hopefully this is today. Blah-de-blah, August 18th, right? That was only a few days ago. So this is a current report. Commercial crude inventories decreased by 6 million barrel draw from last week. 2% below the 5-year average. Gasoline increased by 1.5. Interesting. And that is 5% below the average. And distillates increased by 9. So 1 million in distillates, 2.5 increase in distillates and gasoline, and gasoline, and a 6. So you're netting 3.5. To net 3.5 million draw, right? They used some oil, and it's called cracking the barrel. They cracked the barrel, they refined the product, and they got back. Now they have other barrels full of gasoline and distillates. They open the oil barrel, put it in the machine, and they spit out oil and distillates. But apparently net 3.5 million was sold. The decreased net was 3.5 million. You had 6 million barrels of gasoline, of oil. You now have 1.5 million barrels of gas and 1 million barrels of distillate, 2.5 million. Therefore, 3.5 million went somewhere. See, that's how it works. That's what the actual consumption is. Then you also have to see what the strategic petroleum reserve, blah, blah, blah. Now here's the problem. Look, propane, polyethanol increased 1.7 million barrels. Oh no. So now we have another 1.7 to add to that. Now the 3.5 is being cut in half. And then you want to see also, did they maybe make less? No, not really. They kind of made the same amount. Product supplied is basically the same every day. Okay. And we look at the stocks across. It's really 1614, and you end up with 1611. So they used 16117. So they didn't use 3, they used 2.5 total. All other oils were flat. The strategic petroleum reserve was flat. Was the importing and exporting different? No, not really. We still exported, oh my God, we still exported 4.4 million barrels a day. That is, wow. 4.4 times 7 days. Wait, did that not work at all? 4.4 times 7 days is 0. Isn't that amazing? What is this? 4.4 times 7. Jesus Christ. All right, so it says right here, net imports. We exported 4.4 million barrels per day. That is 30 million barrels for the week. That is 1.5 days of our total consumption is not actually being consumed. Okay? So that's interesting, right? Because if you divide 1.5 by 7, that is 21%. And it's a big long-term scam that's been going on in the oil markets. But what we're saying here is that when people talk about US fuel consumption, they point to this 20 million barrel a day number and say, oh, and so many statistics that you hear are colored by this kind of bullshit, because they talk about our projected consumption for the world is this and that, right? But it's based on things like the United States, which is the world's biggest oil consumer by a mile. There's only 100 million barrels of oil consumed total in the world. We control 20. We consume 20 million barrels, and we only have 300 million people out of 8 billion. We are insane. We are insatiable with our energy consumption. We are the worst offenders on the planet. But even us, it's fake. It's not real, though. That's the point. It's not really 20 million barrels, is it? It's really 16, not even 16. It's 15 million barrels. So let's say 16. It's 20.8. So yeah, let's call it 16 million barrels. It's really 16 million barrels. Yet they're using almost 21 million barrels as a figure that they work these numbers off of. That's crazy. That's giving you such an incredibly wrong impression. And then they base the next number off of that, and the next number off of that, and then that number goes to those, and those numbers go to that. And this report includes that number, which is gotten from this number. It's all bullshit compounded across the spectrum to give you a very false impression of what the actual consumption figures are. But they use those consumption figures then to justify the high price of oil and to justify making more than there is. But if you think about it, what's the reality? The reality is that OPEC has cut back and cut back and cut back, and it isn't helping. It's not changing the fact that we generally have a supply glut. We have such a supply glut in this country that we send 30 million freaking barrels a week out of the country. Okay, 4.4 million. Here you go. What are the world's top exporting countries? What are the world's top 10 oil exporters and the amounts per day? If this thing was 99% accurate, it would be the greatest invention, and it will be eventually, but I mean, if this thing was 99% accurate, it would be the most amazing invention of all time. I mean, it would really change the world. If you could actually expect these answers to be correct and never have to check them. So this is interesting. Oil production, why do you not do apples to apples? They're talking about the exports in billions of dollars and the production in millions of barrels. But anyway, so the biggest producers of oil, you see what 4 million barrels is? That's all UAE does. That's all of Iraq's oil, double Norway's oil, double Kuwait's oil, double Nigeria's oil, more than Brazil produces, not exports. Exports is different. Nobody exports 30 million barrels. Oh, I'm sorry, the Saudis probably do. So the Saudis export, percent of the global is 16.7%. So that means they export 16 million barrels a day. That doesn't sound right. Damn it. You are, stop with the caps. You are mixing measurements. Can you keep it all in barrels? There you go. I feel much better about that. Oh, see, he sees that we export. He's got us at 5 million barrels a day. Whoop, and he stopped working. Isn't that weird? If it stops working, by the way, you go continue. I say, please. My friend and I have been having a big conversation about that. You know, to me, oh, there you go. Your connection has been lost. Isn't that terrible? See, when you correct him, he gets very upset when you correct him. Oh, I see. Now we lost the whole thing. Yeah, when you correct Bing, it has like a temper tantrum and like completely freaks out, and it tends to like do that. It tends to like say it kicks you out of the session or whatever. So you can't continue the session now. It's dead. So I have to go to I have to start a new topic. And you have to be very, very careful about telling Bing that it's wrong if you want to maintain the conversation you're having, because it gets very freaky when you tell it it's wrong. But anyway, the point was we're one of the biggest exporters in the world of oil, which is stupid because we import it and then we export it. And again, we get counted as a huge importer of oil because no other country does this. No other country imports oil and then exports more than they imported. That makes no sense at all. In fact, it's like the water thing I was bitching about today, right? It's so stupid. It's like we take oil from all these countries from all over the world, put it in our refineries. And yeah, of course, it's because we have refining capacity. But we put it in refineries and we send out petroleum products. So it's because we have such tremendous refining capacity, we put it to use by importing oil and then turning it into product and selling the product at a profit. Perfectly good business. But the problem is it distorts everything about America. It distorts all the important data that people are making global policies about. They point to us and go, "Oh, America, you're using 20 million barrels a day." No, we're not. We are refining 20 million barrels a day. We're not using 20 million barrels a day. American consumption is 25% less or 20% less than you think it is. And that's a huge difference considering we're the biggest consumers on the planet. All right, so price of oil, interesting, right? It's especially interesting, price of gasoline, because look at what happened last year. Last year we were at 93, now we're at 81. That is, no, I can't do the math. All right, if it was 10%, it would be 9 less, it would be 83 or 84. So it's got to be 15%. So it's basically 15% less than it was last year. A barrel of oil is 15% less than it was last year. But the price, this is the scam, right? So the oil is much cheaper, but the refiners are charging effectively the same for the frickin' gasoline. So of course they want to import as much as possible. Look at propane. Propane was 110, now it's 63. That's 40% lower. But look at the prices. We were paying 388, paying 386, pay 439, paying 439, 471, 471. We're paying the same as last year, even though oil is significantly cheaper. It's complete bullshit. There's so many ways the oil industry just screws you over. It's amazing. So anyway, so the big deal is here you go, and here you can see the amount. Now don't forget we export just enough to make this number 16. So this number is really 16 million barrels, right? And we consume, but we don't really consume this either. We're shipping some out and there's no breakdown there. But we consume 9 million barrels. So of the 16 million we actually use, it's a very significant part. See all of the products, and those also get exported. There's no way to really pull, I mean, there's no way to pull these numbers out, but the bottom line is, look at, if you look at it, motor gasoline is the largest component. So like I said, it's more than a third then. Probably into like 40% of our total consumption is motor gasoline. And so it's really a big bump when you get a holiday weekend like this and you bump that up by 40%, right? So if it was, let's say US consumption is 6-7 million barrels of gasoline, you bump that up by a day and you bump that up by 40%, you're talking about 3 million more barrels per day. That's tremendous. That's 21 million more barrels this week and 21 more million barrels next week that get consumed. So that's what a holiday weekend does. That's why it's a good time to buy oil, but only if oil is low. And it's not particularly low. It's only the same it was last year. And there's no reason it should be the same it was last year. So it's not a good spot. If we were down to 70, if we were down at 77.50 or 75, especially, I'd absolutely play this long. And if we were up at 85, I'd absolutely play it short. Oh, And how do you get that? You know, go look at the channels in the futures charts, get a futures chart, look at a decently long-term view, like weekly. There you go. And you can see there's a very clear channel. Here's 85. And here's actually further down. And here's like, well, here's 70, right? So I wouldn't call, yeah, see, it doesn't really last below 70, but there you go. You can see that channel. So here, these bars, oh, no, that's not even 85, sorry. Oh, well, it's lower than I thought. It's 80, so it's 8250. So anyway, so it's not actually lower than I thought, so I would not play it, frankly. Have to rethink that. I thought 85 was more of a top, but that's actually more of a spike. And that's why it's always good to change your views on the charts. So really 80 is about as high as we've been going. You know, here's Christmas, New Year's. Then there's just really not, there's not really a holiday. There's Martin Luther King Day or whatever. You've got Easter somewhere around here in Passover. You've got the May holiday was a total bust, right? That comes at the end of May. That didn't work out at all, though coming back from the weekend, it spiked. But these spikes were only to 75. This is completely uncalled for. That's what I was saying last week or 2 weeks ago. This is insane. So that was something we should have shorted. I probably should have called for the short more thing. I think we did short it a bit, but we chickened out pretty quickly because of the holiday weekend. I didn't like it. But this isn't even that low. That's the point. So, you know, when you pull back to the weekly chart, you can see 85 is not the correct shorting line. We never even really hit 85. Here's 85. All right. So, you know, TA, and we talked about this in one of the posts this week, TA doesn't tell you anything except for where the line of resistance is. And that's good to know. So what it means is that there is a point, and if you think about it, you know, most trading is done by computers. So when you hit 85, you can see there's like apparently a very major sell programs get hit when you get to 85. That's the point at which people are saying, I will sell all my oil at 85. Whatever oil I've got, I'll sell it for 85. Oil, contracts, whatever. Okay. And on the other side, when you get down to 70, or, you know, let's try to figure out, let's say this one. Yeah, 70. When you get down to 70, it doesn't mean you can't go below, because you got to think of the mechanics, okay? People are selling oil for whatever reason. OPEC said this, somebody else said that, Biden released these strategic, whatever the reason is. It causes people to initiate selling or initiate buying. And for the most part, there are people who have, excuse me, oh, there it is, almost a sneeze. Anyway, so there are people who initiate a buy program or sell program, because again, there's no human beings doing this anymore. Really, it's just, you know, people are flipping a switch on a machine, but they've all got lines. You don't randomly flip a switch. You flip a switch because somebody did all this hocus pocus and came up with numbers and then said, oh, now we're gonna call a line in the sand and make it at 70. So there's a lot of buying programs that hit at 70. They don't necessarily, on any given day, they don't have the ability to overwhelm the selling programs. So like I said, if it's a short-term thing and a huge amount of people try to sell contracts today because of whatever reason, because OPEC said this or whoever said that, then that becomes a problem. And you can go below the line. But it's not about whether you go below the line. That's why in the 5% rule, I always talk about throwing out the spikes. You got to throw out the spikes. If something goes up and down, one day up, one day down, and you don't stay below the line, it doesn't count. You know, when you see short-term zigzags like we have over here, you know, you see down but back up. In fact, that's actually an even better indicator that there is a line. You go down, spike down in the same day. That's what a candlestick means. In the same day, it came back. And here you go, over 70, over 70, over 70, under 70, came back in the same day. Over 70 all day, under 70, back in the same day, under 70, back in the same day. That means there are certainly people who have a program that says buy anything under 70 and they have a large amount of it. That's where they've set their machines. It takes a lot. It doesn't take a lot for someone to flip the switch on their machine. It does take a lot for someone to redo the numbers, because redoing the numbers, if you think about how an investment house works, means they have to have a meeting. They have to, because one person doesn't make this decision. They're going to have, one, not for oil, not for the Dow, not for the S&P. For IBM, maybe one guy does make that decision. For SoFi, maybe one guy does make that decision. But when you're going to start changing an ETF or a commodity that has massive trading in your investment house, you do not make those decisions on your own. You decide to call a board meeting and you sit down with your people, or group meeting, whatever it is, and you say, okay, I feel that because of such and such and such and such, you make a presentation. Because of these factors, I want to move our buy program from 79 to 82. Whatever. Or I want to move from 79 to 77, whatever you want, whatever your reasoning is, you do that and you're going to move the stick on your buy program. But that's not a fast change. So you're not going to see a big change in one day. So you see a spike down, even if it's for a good reason, it's mostly going to bounce back because the programs aren't changing. They're just, the robots that are buying things just say, oh, somebody's offering oil below 70, I'm going to buy it. Somebody's offering oil below 70, I'm going to buy it. And they keep buying until there's no oil left to sell below 70. And then the market closes at 70. See, you got to think of all these moving components and how not just I want to make a trade, but what's going on? Why is this channel forming? And that's why I'm saying TA is bullshit. TA doesn't tell you that. This is why you see TA. This is what makes you look at a chart and see the pattern. It's not because the chart is making the pattern. It's that fundamentals are causing a pattern in the chart. And it's a very different thing, because the fundamentals come first and then you'll see a pattern. It doesn't go the other way around. Seeing this doesn't tell you anything about what's going to happen after this. And you think about that like driving. So if you're driving down a road, right, and you're going from your house to a destination, okay, and I watch you on the map, the fact that you've driven to, the fact that you've driven from New York to Baltimore does not tell me that you're going to Baltimore, and it doesn't tell me that you're going to DC. It doesn't tell me anything but that you've driven from New York to Baltimore, right? That's the route you've taken. I cannot predict your next move. I can predict you won't drive into the ocean, right? And that's what this is. I can predict you won't go into the ocean up here. There's an ocean there. You're not likely to go there. You might have a floating car. You might be getting on a ferry, but it seems likely to me you're not going to go into the ocean. So that's what I can see from where you've been, but it doesn't tell me where your ultimate destination is. You could be going to DC, you could be going to Florida, you could be going to Virginia, you can be going to South Carolina. I have no freaking idea. There is nothing about this that tells me where you're going to end up, whether you're going to be in Florida or DC or Baltimore with your final destination. There is no freaking way to tell from where you've been. But looking backwards, knowing that you have been in, if I know how far you've gone, if I know how long you've been traveling and I watch your chart, I can tell you exactly where you're going to end up. I can tell you with a very, very good degree of accuracy where you end up. And that's what TA really is. You're looking backwards. And they're always pointing and saying, we'll see what happened before. But they never tell you what's going to happen next. And the whole point of fundamental analysis is to know what's going to happen next. That's what's important if you're going to be investing. Knowing where you've been is a little bit helpful, but it is absolutely not as helpful as knowing where you're going. And you got to take all this stuff into account so you understand it. And to do that, you understand how the chart is made, why the chart is made, what kind of reaction you're going to get from it. And that's why you take all this stuff into account. So anyway, bottom line is, the basic ceiling here is, let's call it like 82.50 is a hard stop, or 83 has been a hard stop for a long time, since last November. Well, really, yeah, really since last November, since we failed it. And then 70's been a bottom. So your channel is 70 to 82.50. We're high in the channel because of the holiday. Most likely we'll touch back at 82.50 into the holiday, or even 83. So over the next 2 weeks, we should get some nice pullbacks. But then you have to keep in mind that the whole thing is bullshit because we're not really doing this consumption. This is not our consumption. But there will be a spike in US consumption that's going to give them some very encouraging figures. But then after that dissipates, they will be very disappointed. So if we get a chance to short oil around $83, we should take it, and then we should be patient for a couple of weeks, and then things should go back to normal. All right, but then you want to say, then you want to check stuff like when is the next OPEC meeting? Do they have like calendars? It's like the Fed. No details are available at the moment. Really? You guys suck. That's terrible. What's the point then? 49th meeting, August 4th. Oh, here you go, October 2023. So there'll be an OPEC meeting in October, and so sometime later in September, they may say something or rattle their sabers and bullshit about that. But the problem is, you know, Saudi Arabia is cut and cut and cut, and it's not helping. You know why it's not helping? Because every day, here's why it's not helping. How many electric cars have been sold in 2023? Another record. Expects country 1 million new EVs in 2023. Okay, so how many cars are on the road in the US? Wow, we have more cars than people. That's crazy. 300 million. But it doesn't really matter. What matters is 1 million cars a year. It's two things that really matter. 1 million cars, okay, average car 15,000 miles. Average mileage on a car is going to be, let's say 25. Let's give it the benefit of the doubt. So that's 600 miles per, 600 gallons per car divided by 42 gallons in a barrel is 14 barrels per car times 1 million. It's going to be 14 million, obviously. So 14 million, every time they sell 1 million electric cars, there's 14 million, completely wiping out the consumption of 14 million barrels every time they sell 1 million cars. Plus, that's happening all around the world. So back to our previous question, how many have been sold in 2023 globally? 2.3 in the world. Oh no, in the first quarter. So 10 million in the year. So that's 140 million barrels less oil. That's 500,000 barrels a day less oil. But that's not even the big problem. The big problem is, and this is really a Bing question, but here you go. So here's what we say to Bing. Oh, I forgot he was didn't like me today. All right, continue, please. No, why say? What should we talk about next? Okay. So, I'm trying to figure out how much less gas is used by new cars versus the used cars people trade in on average. How much less gas is used by new cars versus the used cars people trade in over the course of a year to figure out the net savings of barrels of oil per year. So let's see what he comes up with. You need to know the average fuel efficiency and the annual mileage of new cars and used cars, as well as conversion factors between gasoline and grill. Here are some factors that might help out. Okay, the average fuel efficiency of new cars sold in the US was 25.7 miles a gallon. That means my other figure is way too high. While the average fuel efficiency of used cars was 22 miles per gallon. That's interesting. According to the Federal Highway Administration, the average annual mileage of vehicles in use in the US in 2020 was 20,000 kilometers, down from 21,007, according to just in 1 barrel of oil, blah, blah, blah. Using these factors, you can assume, plugging in those numbers, you get, this means that one new car consumes 2.5 barrels of oil more than a used car per year on the average. This is because the new car has a higher fuel efficiency than the used car. However, this is, of course, it's simplified. Okay. So how many new cars are sold in the US annually? $16 million. Yep, that's the right number. All right. So it's another 16 million barrels times 2.5. That's 30, blah, 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 and 45. And I think the mileage difference is much bigger than he's stating, because I don't know where he's getting the numbers, but it's not worth checking out right now. But conceptually, I mean, here, what's the, in 2023, what is the current CAFE standards for new car fleets? Yeah, see, it's increasing a lot more. He's going by 2020, and the increase is very significant. So they want a fleet-wide average of 49 miles per gallon by 2026. That's huge, because you're comparing it to used cars that are around 20 miles per gallon, and you're going to go up to 50 miles a gallon. And that means 16 million cars per year that get 20 will go by half, will drop half every year of their total fuel consumption. You go from 20 miles a gallon to 50 miles a gallon, it's actually more than half of what you're using. So it doesn't seem like a lot, but incrementally, this is a relentless drive, whereas the fleet of cars turns over, and if we have 300 million cars, 16 million cars a year, it's going to take 20 years to cycle out all the old cars, and that doesn't include the people who keep 20, 30-year-old cars. But in about 20 years, we're going to pretty much recycle the fleet of cars to use half as much gas as they do now. So if that's going to take 20 years, that means every year we're using 2% less gas, which is a lot less gas, just in turning old cars into new cars. you've got that, and then you've got the bonus bump of the electric cars, which are taking a tremendous amount of gasoline off the market. 500,000 barrels a day coming off the market from electric. But that doesn't go away. It's a 500,000 this year, 1 million next year, 1 million the year after, 1.5 million the year after that. And that's only if they stay steady at 1 million. If electric start ramping up, all of a sudden you're going to take off 2 million, 3 million barrels a day off our total consumption, which is significant. And it's not just the US, it's happening globally. And in fact, we're slower than every other country to do these things. And that's why oil, you don't see any energy companies in our portfolio. That's why oil and energy are a downhill bet. It's a dying industry. You just, it's just dying so slowly, you don't really see it. But this is a dying industry. We are moving away from powering our cars with fossil fuels. And the fossil fuel industry is why they're fighting this. They're fighting people who believe in climate change. They're fighting people who are for the environment. They don't want to hear any of this. They got to keep this thing alive as long as they can. And I think I talked about this last time, right? I mean, we have to privatize these industries. We can't let them keep running the way they're running. We have to take them over. And by the way, government takeover is not a terrible thing. I think I said that too. You don't take them over like a communist thing where we're like just saying, everyone get out, we're taking your company. No, you buy it. It's a public company. Exxon, $400 billion, buy it. We waste money on all kinds of shit that doesn't make any money. Buy Exxon. Buy them all and have a 20-year program to say these companies will be drastically reduced or non-existent in 20 years. We'll get our money back. The government will get their money back. These oil companies have PEs less than 20. So the government will run the company and get their money back, but they'll run it to shut it down. Exxon is running the company to expand. Exxon's running the company to sell more fossil fuel, which is counter to the survival of humanity. But anyway, not what this is about. This is about why I don't want to invest in in electric companies, and why I don't want to invest in oil itself. I don't want to be bullish on oil. I have absolutely no belief in the story of being bullish on oil. Even with a war going on, even with this stuff, and a war, by the way, that involves the world's second largest, third largest oil producer, Russia. Even with that going on, they can't get oil over 80 bucks. That's a problem. Oil is in deep, deep trouble. It is a declining thing, and that's why Russia's in deep, deep trouble, because they rely on this oil. This is the major source of income for the country. For the Saudi states, for the UAE and people like that, it's 90% of their economy, 90% of their economy. That's why these guys are running around doing all these projects that are non-oil projects. That's why they're getting into renewable energy. They know what's going to happen. You think the Middle East is a mess now? Imagine what's going to happen when they're broke. Right now, they have all these shiny cities and fun stuff that they get to build with all the oil money. It's all going to go away in 20 years. Over the next 20 years, it's all going to be gone. And all the production cuts that OPEC does are meaningless unless they're going to cut 5% a year of their total production. That's 5 million barrels a year they have to cut back. They're not doing that at all. And they're not going to do that at all. They are going to have a glut, and it's going to become very obvious to people, and it's not going to be fixable because who's going to cut? If you want 5 million barrels cut, because right now the Saudis are most of the cut. OPEC's got like a total cut of 2.5 million barrels or something like that, because the consumption's not there. It hasn't fixed any balances for the Saudis. OPEC's not in alignment anymore because it hasn't fixed anything, because 2.5 million wasn't enough to cut, and it's not coming back after COVID because we've replaced all these cars and we've got all these electric vehicles going around. So their cut is just to offset that. And next year, though, those cars are still going to be in use, and another 2.5 million barrels need to be cut. The Saudis can't just keep cutting 2.5 million barrels. They're going to have no money. Russia sure as hell isn't going to cut it. They're broke already. Macros. This is macros. It's always happening in the background. That's the kind of stuff you got to watch out for. See if we have any questions. No questions. Wow. Okay. I am so fascinating. It blows my mind. People just sit and listen and have no questions. All right. Anyway. According to the VIX, this is not a volatile market, which is really fascinating. That's interesting. Take a look at that. So here's the dailies, and we go up 2,500, down 1,000. And the VIX basically has gone down for the most part over this time period. I mean, is this not volatile? Is this not volatile? Looks pretty. This looks pretty volatile to me. And that's another thing. Okay, if you look at the Nikkei, the Euro stocks and the DAX all agree that things are not that great. Not our markets. Our markets are back to pretend mode, where they're taken off for no particular reason. And, you know, we talked about this stuff in 2007. We talked about it all the time. I used to run that speech from Meatballs that says it just doesn't matter, because there was so much crap happening all over the world, and America would just ignore it and ignore it, ignore it. And until it finally comes to shore and it wipes everything out. I mean, it's just crazy how we ignore what goes on in foreign countries. Like, we act like this is not important. It's very important. This is very important stuff. Europe is in bad shape. Japan went from 34 back to 32, but we only dropped half of that over here. Our pullback was half of what Japan's was, and Europe was much more severe. This is 45 to 42, and now it's 43. But we did not have this kind of pullback at all, because we're unrealistic. Not because we're better, but we're more unrealistic. And that's because, European CEOs are extremely forthcoming in their reports, because the rules are different there. It's all, for a CEO to lie to the investors in Europe is a huge problem. It's I mean, such a thing that they don't do it. The Japanese also will tend to be very accurate with the reports. Forget China. China's, you're not allowed. You're in China. It's a total opposite. You're not allowed to say what's actually happening. The state doesn't want that. Anyway, so we got energy we talked about. All right, that's too high. Bonds. Bonds have been crash, and all of a sudden they're bouncing back because we were trying to pretend that the Fed is done tightening. Orange juice was a great pick, but it was lower. We picked that a while ago. So actually, it goes longer back than that. It was like 250 or something, right? Yeah, somewhere around 250. I was like, orange juice was too cheap. Now it's good. But again, it's macros, okay? It wasn't complicated. The crops were getting killed. The orange crops were getting killed earlier on in the season, and therefore orange prices are going to be higher. It's not very complicated. Coffee, ooh, I like coffee. Ooh, I like coffee down here. Coffee should be at 200. Let's do weekly. Yeah. And coffee's the same thing. All these heat waves are bad for crops. Heat waves and droughts and so on and so forth are bad for crops. Coffee is a very delicate crop. So if you haven't heard about a problem yet, you're going to hear about a problem later. But coffee is a problem crop. Gold, consolidating for a breakout, so is silver consolidating for a breakout. Copper is an indication that industrial demand isn't as high as you think it is. Palladium's interesting because palladium supposedly is used in the catalytic converters, and it's used in the bits for the electric engines. Oh, well, oh, that's true though. The electric cars don't have catalytic converters, do they? I wonder if that's what's keeping palladium down. Didn't think about that. Meats, cattle, still insane. Look at that. Oof. Hogs not, though. That's weird, huh? People aren't switching to pork. Grains. I will tell you that I've noticed a very big decline in the quality of meat in most places I go to, and I get really pissed off. Because it's not good for you. You know, it's like that's the problem. It's like if I have a steak, it's like not good for me. It's a treat. I want a good steak. I don't want a bad steak because now I've eaten the steak. You know, I should be one of those people who throw stuff back at the restaurant. But you know, you give me a bad steak, I'm still going to eat the bad steak. But now I've eaten my steak, and I'm not going to have. I don't want to have steak again for like at least a couple of weeks if I'm going to have it. So you ruin. It's a horrible thing to do to me to give me a bad steak. I really look forward to it, and if it's not good, so I just cross these restaurants off my list. But I got to tell you, I'm down to like only about 4 or 5 restaurants I'll go to with a good steak. It's an epidemic. And then, you know, that's what happens to restaurants in a recession or when there's inflation. This is a problem because if it's not a gourmet restaurant where the chef is like really in charge of the food, and he's going to check everything. But even so, like I said, my steaks have gone downhill and I go to some pretty good places. But in a regular restaurant where the owner or corporation is making decisions, they don't. I'm sure there's some input from the company on the company level, like from the people who actually care about quality. But you know, when they get an offer and they get a cheaper sugar, cheaper ketchup, a cheaper cut of beef, you know, they'll switch suppliers. Because you know, the Cheesecake Factory, not to pick them out because I frankly haven't noticed, I haven't gone there lately, so I have no idea what they're doing. But the Cheesecake Factory has a chicken and pasta salad, and they look at every ingredient in their chicken and pasta salad and determine, can we get this ingredient cheaper? And is it going to impact sales? Now, most people don't have the the taste buds to care. I mean, that's the reality. If you guys are, if anybody's a foodie, you know this. I mean, it's just crazy how you can tell the difference between stuff and your friends can't, and it drives people nuts. Then you meet fellow foodies and you're like, oh, you speak my language. Like me and Jackie, like Maddie could care less what she eats. You know, she likes good food, but doesn't matter to her. You know, it's like food is food. For Jackie and I, we're like, oh, this is not a good potato. You know, we're both like, you know, she has my taste buds, and we're like just really picky about things. So it's a very different experience. But what were we talking about? Oh yeah, the point being that the restaurants will make decisions that can be fatal, and they don't realize it. Like you change suppliers, like potatoes or whatever. You buy this guy's potatoes or that guy's potatoes. You buy this one's ketchup or that guy's ketchup. The place down the street from me, place Granger's down the street from me, has the best hamburger in town. Still have the best hamburger in town, but they changed their ketchup from Heinz to God knows what the hell it is, but it's awful. So how do I order a hamburger? I only order the hamburgers takeout now. That's my solution. I have to take out the hamburgers. I can't eat the hamburger in the restaurant because if I eat it in the restaurant, they got the crappy ketchup, and I feel like an idiot bringing my own ketchup. Tempting though, but it ruins the hamburger. The whole hamburger is ruined because they have bad ketchup. And I said, I had a thing with the owner about it. I talked to him. He's like, I don't see how it makes a difference. I'm like, it makes a huge difference. How do you say it doesn't make a difference? It's like half the flavor is coming out of the ketchup. But anyway, so that's what happens. It's little things like that, and it's not just restaurants. It's whether or not you make the kind of buttons that crack. You know, like some buttons when they get cleaned and they come back, and after a while they kind of start cracking. You know, on the shirt buttons, if they don't use good quality buttons, they start to break after time. You know, why? Because the guy changed to a different button supplier that was charging him less money, because that one comes out of China instead of coming out of, out of Thailand where it used to come, or whatever, whatever reason it cut back, or it's made out of a slightly different material, but it doesn't last as long. It's more plasticky. There's a million things like that all through the supply chains. So when they work out these supply chain issues and they move manufacturing and so on and so forth, it takes a long time for things to get back to something like normal. But normal is not normal, because normal is like, if you think back through recessions, there are whole restaurant chains that disappear. Like they were going well, now they're gone. And there's restaurants, and even non-chain restaurants. I mean, you know this. You go to a restaurant, it's not as good as it was anymore. Why? It's mostly because they changed their chef or they changed their suppliers. And either one can destroy a restaurant. You can have the same chef, but a different supplier. So the food looks the same. It's the same menu. It's got the same food, but it doesn't taste as good as it used to. And the same thing goes if you make a car. It's got the same parts, it's got the same buttons, it's got the same design, but it doesn't work like it used to. Range Rover is a great example of that, right? Right, I don't know how many people have a Range Rover, but I mean, a Range Rover is nothing like it used to be. And then it costs double, and it's half as good. Very, very, very disappointing. I mean, they used to be, a Range Rover used to be a living room wrapped in a tank. That's the best way to describe it. It was like a gorgeous living room with fantastic sound system and unbelievably comfortable chairs. Like, I'd rather sit in the chair of a Range Rover than sit in my living room. And I'd rather listen to the sound system in my Range Rover than go home and listen to music. So the whole thing was like, I would almost rather be in my car, basically. And that's how Range Rovers used to be. This is going back 20 years. And these days, it's just a really expensive car that isn't much better than any of the other expensive SUVs. It's very, 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 very sad. So I guess I'm just old and grumpy. I'm sorry to be old and grumpy, but things like that piss me off. But anyway, this is how things unwind. This is how companies lose their position. They lose their marketing. And you got to care when you're an investor. You got to look at the little things. You got to care about stuff like that. And that's also why we don't have a lot of restaurants right now, because those are very sensitive. But so is stores. Look at Foot Locker got crushed, and Macy's got crushed, and Nike's getting crushed. And let's take a look at some of those. We get charts. Here's Foot Locker, which we just started buying today, because I'm like, that's getting silly. So we started buying Foot Locker today. We already had it in the long-term portfolio. We basically doubled down on it. The problems they're having are changeover problems, inflation, inventory adjustment. They have to adjust for the new market. What do people really want? People are not looking for the flashy stuff anymore. They're looking for basics. It's tough for Foot Locker. Also, they're in malls, and the traffic in malls is getting killed. So that's another problem. So there's all sorts of things like that. Then Nike, who sells their shoes to a place like Foot Locker, and Nike's not doing so well. And also, why? There's another good thing. Why shoes? Because shoes are very discretionary, right? Think about one of the things that was very common in the recession, not the recession, in the Depression. So in the Depression, think about the images of people's shoes with the holes in them, and the ways people would fix their shoes, and so on and so forth. They would wear their shoes until there was nothing left, because you can't. Shoes are not that important to get a new pair of shoes. You don't get a pair of shoes because it's got a scuff. You don't get a new pair of shoes because it's got broken, because it's got a tear in it somewhere or whatever. People go like that to school. They're not, you're not ashamed to have used shoes in a recession. It's a big change, and it happens quickly. And especially shoes. That's like one of the first things to go because they are pretty durable, and we do tend to, first of all, have way more shoes than we need. I think almost everybody has more shoes than they need, right? I think everybody's, even guys have like 10 different pairs of shoes in their closet. For what? And women forget it. I mean, I know too many girls who have shoe closets. You know, that's a crazy thing. But so you think of things like that. So of all the things that you have, right? I mean, maybe t-shirts also, right? You have too many t-shirts. But of all the things you have, it's got to be like shoes is one of the top things that people have way too many of, don't need to buy more of. And so the first thing you're doing if you're cutting back on your spending is you're not going to the store and buying another $200 pair of Rockports or whatever. And certainly you're not buying a $300 pair of Air Jordans. If you have a functioning pair, right, you keep your old one, call it a classic. So certain consumer habits change quickly. Also, one of the reasons I've never been a big fan of Nike when it's been high, because we bought Nike when it was super low, but whenever Nike gets up to like 25 times sales or something like that, I'm like, why do I want, not 25 times earnings. I'm like, why do I want this? Why do I want an overpriced sneaker company? It doesn't make sense. Now, I like Crocs, and then we do have Crocs actually, but Crocs is probably also taking a hit because that's what the whole shoe business is. Yes, Crocs took a bit of a hit, but I like Crocs because Crocs, first of all, is way lower PE. I think their PE is below 10. Oh, I can tell you in a minute. Crocs. And Crocs is having a rough year too. We knew that. But, oh, 7. See, PE of 7. They're having a rough year, but they're doing things I like, and I think they're going to be in good shape in long term. I certainly like a 7 times earnings shoe company compared to a 30 times shoe company of Nike. And also it's their positioning. You buy a pair of Crocs, it's $40, $50, whatever. You buy Nikes, it's $300. $100 sneaker is cheap now for Nike. So in a recession, who's going to sell more? Who's going to sell more stuff? Crocs is going to get the business. They're not, I mean, they don't, and that's their big problem. Crocs started a new shoe brand, a new, whatever the hell it's called, I forget now. But Crocs bought a more regular type shoe company, and they're integrating, and that's what's causing them problems. But not such problems that they're not still making 7 times earnings, right? So when they get this thing working, assuming they didn't make a huge mistake on the new brand, and there's no evidence that they have because the money's coming in. They went from 3.5 last year. They're going to 4 this year. They're up more than 10%. They think they're going to be up 10% next year. They seem to be executing. It's just a slow grind to push everything together. But the point is, they're in the right scale of the category. Macy's, and we talked about this once also. Macy's is in the wrong place. Macy's is right in the middle. So Macy's and Bloomingdale's, right? But Macy's and Bloomingdale's is below Nordstrom's and below Saks as far as luxury, like the kind of people who shop at Nordstrom's and Saks are not necessarily going to be Macy's shoppers. It's not likely that they're going to move down in category. And people at that level of income don't have to, because the stuff you're buying, your clothing and accessories, that stuff is not a big portion of your income when you're wealthy. And that's something you also have to consider. Middle-class people have a very different breakdown of expenses as a proportion of their income than wealthy people. Because for wealthy people, they've got much bigger home expenses than you would, but it's still in proportion to their income. But that makes, since their home expense is so big and their auto expenses are so big and so on and so forth, the amount of money they spend on clothing and things like that becomes really inconsequential to them. in the grand scheme of things, right? If you're going to, so if a rich person is going to cut back, they're going to buy a Mercedes instead of a Bentley. They're going to buy one less, well, not an entire less home. They won't buy that vacation home, and they'll save $400,000 that way. So they save $100,000 on the car and $400,000 on the house they were going to buy that they decide not to, and all of a sudden everything's fine financially for them. And they're certainly not going to stop going to Saks and start going to Macy's because they don't like anything Macy's, and they don't have to. So Macy's doesn't benefit from customers going down to their size, but they do lose a lot of aspirational customers who shop at Macy's but really should be shopping at Target or Walmart or whatever, or JCPenney or whatever the lower tier. Yeah, I don't know because I shop at Macy's, but whatever those other stores are, people go to. But no, I got into Target because it blew my mind, honestly. Because when my kids started getting to the age where they would buy clothes, right, they would go with their friends to buy clothes. I would just give them $100, say, here, go to the mall, buy clothes. But when they got older, like, 10, 11, 12, when they started getting to the age where they would make these decisions, and they would ask me to take them to Target. And I'm like, and I'm buying, and my job, like, they get sent out by my wife, and she goes, oh, go buy the kids clothes for school. So I go and buy the kids clothes for school. I'm driving to Bloomingdale's. They're like, we don't want to go to Bloomingdale's. I'm like, what do you mean you don't want to go to Bloomingdale's? What's wrong with Bloomingdale's? And now I like Bloomingdale's because you walk into Bloomingdale's and basically a woman comes up to you and is like, she takes care of you the entire rest of the time you're there. It's like having a personal shopper. Like, she's like, get this, get that. Everything's boom, boom, boom. There's no waiting in checkout. Everything's there. Everything's in stock. It's freaking great. I mean, for somebody who doesn't want to shop, I'm like, you're in and out of there. My kids are happier, and because they get price conscious from going to the mall themselves with their friends, they're like, I'm not spending $30 on this shirt. I can get a shirt like that at Target for this. And Old Navy, that's another one with super discounting. So, I and I got to like Target after a while because I was like, holy crap, you can buy basically this. You can buy clothes. You can buy things that are good enough that are fine, and they're half the price or less than half the price of these other stores. So again, whenever you get squeezed as a Macy's kind of shopper, Bloomingdale's kind of shopper, you're going to get squeezed pretty quickly down, and you're going to go to those other stores that are cheaper. So it's a big problem to be in the spot that they're in because there's no trickle down, and they lose a good portion of customers. And again, Macy's is in the malls. Malls are massively struggling still, massively struggling. And by the way, another wave of COVID is coming around, and they don't know, the last one was a bust. So we're not going to get too freaked out. But this time, I haven't had a vaccine since last November. So the last time it came around, which was in the early part of this year, there was a new variant of COVID. It wasn't a big deal, but we all just got vaccinated because we were still in that thing where we were paranoid from 2022. Now people haven't had boosters or been vaccinated in a very long time. So I'm a little bit more concerned right now of what's going to happen. But there's a lot of these places, and again, that's when I look at places, when I look at stores, and whenever I look at anybody in retail, I always look here. Did they lose money? You can not make money. That's okay. That doesn't force you to borrow. Okay, but losing money, like this, that's dangerous because they lost that money. They ran up their debt. Well, actually, Macy's it's one thing I like about Macy's. They sold real estate to cover their debt, so they actually lost it. That's always complicated. Like, how did they pay off their debt? They paid off their debt by selling some assets. So now they no longer have these assets. They have to take that into account of what the store is really worth. But anyway, the fact that they take a hit like that, and that goes back to cruise ships. Why don't we have any cruise ships? Oh, there's a really good reason we don't have any cruise ships. Look at this. They can't take that again. That's 10, 11, 12 billion dollars that they lost, and it takes them 6 years to make that kind of money. That wipes out it's 3 years of losses, 6 years of earnings is wiped out, so you're net zero for a decade. I'm not going to invest in that. Is this over? My kids just took a trip. My kids just took what was it? Norwegian Joy. The Norwegian Joy. They went from the New York port. I forgot what that's called now. Oh, that's terrible. I haven't been there in like 5 years. I forgot what it's called. Anyway, the actual port at New York, like where they have the battleship. There's a few ports over there. That's where it leaves from. And it just 2 days to Bermuda. Hang out in Bermuda for 3 days. Basically, the boat is your hotel, and then back. That was their trip. But they loved it. They loved Bermuda. They thought it was great. And Jackie really liked it. Jackie was thrilled. She was telling me yesterday that just getting to explore the island. You know, it's like to actually have the time instead of the way the boats are, where you go somewhere, you walk around a bit, or you do one activity and you're done. That's it. That's your whole. You didn't even see the place. Hanging out there for 3 days was perfect. So anybody who lives in New York, it's a good trip. But anyway, so they were on the Norwegian cruise line. They liked it. I've been on Norwegian before. I did not like it because it was too much of a drink fest for me. But exactly for that reason, they loved it, because she's 21 now. I just can't get into something. I don't want to own something that this could happen to. There's no recovery. It's a decade of lost money. And it's amazing to me how fast people jump back into these things. You know, and not 100%. You know, it wasn't 120, but this is 100. You tell me it's only it only bothered you 20% that they can take this kind of loss? That you never know when this is going to happen to them? I just don't see it. And yeah, of course, logically, if you think everything's fine going forward, you're only talking about 12 times, 13 times earnings going forward. So great, you got in after everybody got flushed out. But to me, it's just too scary. And these guys have heavy, heavy debt now too. You know, $20 billion, $21 billion of debt. Oh, and look at that. That's get rid of this. That's your working capital, -8. So they have to raise money. -8 working capital and 20 billion in debt. That's not sustainable. That's not a buy. Is it NCL is Norwegian? Nope. Norwegian. Oh, NCLH. Well, how would I know that? So Norwegian lost 4, and 4 is 8, 9, 10. So over $10 billion. $10 billion. Oh, price to book 482. Wow. So bankruptcy risk. That's not good. So even though they have a PE of 13.4, it's the same problem. Negative working capital, massive debt. And nowhere near the kind of earnings that Royal Caribbean has. Royal Caribbean has almost $2 billion of earnings. These guys have a few $100 million of earnings. And who's the other one? Carnival, CCL. Look at that. Royal Caribbean's got the best earnings by far. Wow. Look at Carnival. 10, 20. It's like it's around $27 billion. This is a $19 billion company that lost $27 billion in 3 years and have taken on $30 billion in debt, 20 billion additional debt from where they were before COVID. So they lost $30 billion or 20, but what did I say? Is it 30? Sounds like a lot. 26, 27 we decided. All right, 27. That was $27 billion plus took on 20 billion debt. That's $47 billion negative. 47 billion negative dollars, and they've got no money. It's horrifying. And if you look at it, well, actually, they're kind of reflecting that. But shouldn't they be even lower? I mean, how are people doing this? This was about 50 bucks, 40. Let's call it 50 bucks, and now they're at 20 bucks. Not even 20. They're at 16. These guys probably shouldn't be at anything. This is like WeWork. How are they going to make this money back? At what point, if you're giving them 20 billion, you're giving them $20 billion when you buy the company, and you always got to think about a company like that. It's not 1634. You're paying $20 billion for Carnival. So Carnival, what are you going to do with $20 billion? Well, we hope to make $1 billion next year, even though it seems like bullshit because we're losing money this year. But next year we hope to make some money. And God forbid anything goes wrong. It's an industry that can be shut down overnight. And they're $50 billion in the hole already. And you're paying $20 billion to buy this freaking debt burden. So you're paying $20 billion to take on $50 billion worth of debt in a company that's losing money. And if you think about it, they can't really do better than their best year because they didn't build any more ships and they don't buy any more ships. You can't stuff more people into the boat. There's capacity limits, right? So what are they going to do to improve it? Are they going to raise prices? Well, you can't really raise prices when Royal Caribbean seems to be managing to run in a nice profit. That's your competition. So Royal Caribbean is managing, they've got a smaller fleet, less money in revenues, but they're making much more money in profit. So what happens? Carnival has to sell some ships to pay down their debt. Royal Caribbean says, we'll buy your ships for 60% of the price or whatever. And then Royal Caribbean has a lower operating cost than Carnival. And now they can afford to have more ships on the sea at lower prices. So Carnival is never going to be able to raise their price, no matter what bullshit plan they try to sell you on that says they're going to turn this around and do that, and they're going to strategically realign this and blah, blah, blah. Bullshit, bullshit, bullshit. You can't control the macros. That's why the macros are so important. What are the real trends in this industry? What's driving stuff? So between the risks that they could be put out of business tomorrow by another $30 billion or $50 billion in losses from more COVID, and the fact that they barely stand a chance of surviving anyway. I'm talking about Carnival, not Royal Caribbean. And Royal Caribbean too, though. Like I said, I mean, I love Royal Caribbean. They certainly now that you compare it to Carnival, you're like, wow, these guys are geniuses. How did they manage to do so much better in given the same situation? So I like Royal Caribbean. I always like Royal Caribbean, but I can't take on this kind of risk. If it was still at 25 bucks or 50 bucks, I'd be like, yeah, okay, that's worth the toss. If it was trading it at 5 times earnings or something like that, I'd be like, yeah, okay. I mean, let's hope there's no COVID and get it back. But you are now aware that the entire the entire cruising industry can be turned off, as can the hotel industry. So there's, post-COVID, there's certain things that we're not too keen to invest on that we used to love investing in. Because, when you're running a worst case scenario on a hotel, I didn't really run the worst case scenario that all Marriott hotels around the world will be closed for a year. That was really not on my list of things to worry about with Marriott. You could worry about them losing 20% of their market share because you have a recession, you can worry about things like that, but zero, not only zero, but zero revenue, and you can't cut your expenses. So just like these cruise lines, multi-billion-dollar losses. There's nothing you can't fix it. You can't plan around it. You're not going to be smarter than the macros. That's what happens. Look at Marriott, though. They only lost $267 million. That's amazing, right? Because the hotels weren't totally shut down. I went to a convention in Vegas. I remember that. We had to wear masks everywhere. When was that? That was Maddie's 21st birthday. Ah, I know when it was. It was no, it wasn't her 21st. It was her 22nd, or it was sometime between after her 21st birthday, because we were supposed to go to Vegas for her 21st birthday. And I guess we went when I had a conference or something that I went to. Anyway, so sometime in 2021, in between 2021 and 2022, we went to Vegas, and that was for me traumatic. I had to get on the plane. I was worried about getting COVID on the plane. I was in the freaking hotel, and I'm like, oh, I was worried about getting COVID in the hotel. It was crazy. Not worried enough that I didn't play poker. I still play poker. Which is funny, because there's a casino like 30 minutes from where I live. I never go. I only play poker when I'm traveling. But anyhow, so Marriott managed not to lose money, and that's a respectable company, right? That's exciting. But they came back way too fast for my taste. They're trading higher than they were pre-COVID. And it's 22 times earnings. It's, to me, too much of a premium. But look, it's a great company. Holy cow. Oh, my voice is going. That's not good. Hang on. Yeah, apparently talking for 90 minutes is very stressful on your voice. All right, all good otherwise. So what do we talk about today? Oh, this is the current screen. Ooh, what the hell was that? Mobile page, no mobile page. I don't even know what that means. Is that always there? So how was the 20-year auction? What happened? Oh, gotta ask Bing. Oops. Was the result of today's 20-year auction. Yeah, so we see it's a little bit higher than it was. The rate was higher, the bid to cover was lower. That means less people are bidding and they're demanding higher rates. That's not a good combination. Indirect bidders bought 60%, which is better. So more foreigners bought this time. And direct bidders bought 13.7, which is lower than last time. Weaker domestic demand for bonds. But that's not good. They don't want that. And the Fed buys the rest, whatever's left. Not ideal is how I would put that. So we talked about that, but then we got into a whole thing about the water and water scarcity and so on and so forth. This guy's so funny. Dead now, but so funny. And Robo John chimed in. He was also funny. And then what do we talk about? All right, well, actually, you know what? We talked about what we weren't buying. Now let's talk about what we are buying, or what we have been buying. So we check out top trades, and we just did one on IBM yesterday. So even though IBM is kind of in the top of the channel, I set it up for the butterfly portfolio. And so in the butterfly portfolio, oh good, we have two pictures of it. So we're playing it conservatively. So we're taking the 135, 160. So in other words, if I was really making a hardcore investment in IBM, I'd rather have something like the 115s or the 110s and sell the 130s. And I'll show you why. Because if we said the 110, 30, 38, call it 38, and the 130s, and we're saying 22, so 38, 22 is 16. I wouldn't do that. Well, there's a problem right there. I'm not gonna buy a $20 spread for $16. That's idiotic. So then I look at the 120, which is 30, and the 140, which is 16. That's 14 bucks. That's not quite there. So maybe the 130. Oh, that's how we ended up there. Okay, so there's my process of elimination. I'm not going to pay $17, $16 for a $20 spread. That's just silly. So what we ended up doing was taking the 135, 160. So we played it more bullish, and that spread is not one. I'm sorry, it's a 140, 160, and that's an 850 spread. So it's a $20 spread for $850. I'd rather have that that's at the money. But then that's a very high goal, right? So instead of just playing it straight up, I'm taking this thing for 8. Don't forget it was 16. If I wanted the 110, 130, that was $16, $17. That's insane. So instead, I pick up the 140s for $8 or $8.50. But well, we were going to sell the puts anyway, but now the puts have a much bigger effect because the puts are knocking $5 off the price of each long. In other words, 10 puts against 20. So they're knocking $5 off of each long spread. So now my $8.50 spread is now $3.50. And that's just by selling the puts. So what am I really doing? I'm promising to buy 1,000 shares of IBM for $1.30 for $135. But I know I can roll them. And I can pretty much roll them down $5 to $10 every year. So by the time I have to buy IBM, it'll probably be about 120 where I'm very comfortable owning it. So I got no problem selling these puts. And also, I'm selling the calls. I bought 20 longs, sold 15 shorts. That means I have 5 uncovered calls. So I'm overselling. I'm selling 7 short calls. But that's because I think IBM is toppy in its channel here. Okay, I don't see it had its earnings. I don't think it's going to have a major breakout. Even if it does, I've only got 2 uncovered calls. And again, roll it, roll it, roll it, roll it to higher and higher strikes. So if all's going well for IBM, I just keep rolling these higher and I end up with a nice spread. And you know, eventually we'll deal with the two short extra calls is not going to kill me. If IBM goes down, there's $3,220 in our pocket, and we only spent $77.80 on the spread. So I've got 2 full years, all of 2024. No, I'm sorry, I don't have 2 full years. These are 2025s. So we have until January of 2025. We have all of 2024, and what's left this year, 5 quarters to sell. So here's 1 quarter sold for $32.20. We can get another $12,000 out of next year. That's more than I'm paying for the spread, and that means the spread's going to be a bonus. So not only that though, but if IBM takes a dip and I can roll my 140 calls down to the 130 calls for $5, right? And how much is $5? 5 times 20 is going to be $10,000. So instead of spending $10,000 extra here, I can optionally always roll these guys down for $10,000 and widen the spread by $20,000. And there I'm getting the 2-to-1 that I want, right? So I'm not going to overpay here to be in the money, because if things don't go well, I'll just roll these down. If things do go well, I'm going to make, well, if things go well, I'm paying $8.50. Forget the short puts. I'm paying $8.50 for this spread. If things do go well, I pay $8.50 and it will get to $160 and I will collect my $40,000. If things don't go well, then I'm glad I didn't pay $16 for this, because all I'd be doing is hoping it doesn't fall below into my range. And instead, I'm going to then spend the extra money, the extra $5, $10. So it's going to go from $8.50, $5 more is $13.50, right, for getting the puts. And then I'd be in $13.50 on a $30 spread. And then if I spend $5 more to roll down to the 120s, I will spend $18.50 for a $40 spread. That's more in line with where I want to be. And of course, if we're going down, then the money I'm spending is being paid for by the short calls I've been selling, because those will expire worthless as it goes down. So can I ultimately get burned on IBM? Well, of course, we still have the open puts. So there's, you can roll it and roll it and roll it, but if it really goes down, there's a limit. But that's why I like IBM, though. I feel very comfortable about it like that. That's why it goes in the butterfly portfolio. I feel this is a very high chance of success and a very high chance of staying in this 120 to 150 range where I'm very comfortable making plays. Then 2 weeks ago, we added Allstate and Prudential because the insurance companies have been beaten up. I don't see the Prudential one. There's Prudential. The insurance companies have been beaten up, and rightly so, because of all the natural disasters and the fires and the whatevers and so on and so forth. But we pulled the trigger because insurance companies are frankly doing the right thing. They're pulling out of Florida, they're pulling out of California, and they're saying that you guys live in unstable states. You guys live in states that catch fire and flood and have all these disasters, and it's too hot, and your ocean is boiling in Florida. We're not insuring this shit anymore. So good for them. There's a whole world to insure. They don't need to insure Florida and California. Sucks if you live there, but that's the reality. So I think it's a great move. I think it's going to obviously impact their current earnings to knock out 2 major states like that, but they will find other things to sell and other ways to do it. Insurance companies are very, very flexible and very innovative. You don't think of them that way, but take data insurance, right? That was not even a thing. 10 years ago, there was no data, there was some, but it wasn't a big thing. There's cybercrime insurance, data insurance. When you come up with something new, they'll figure it out and insure it. All they do is run the numbers and decide whether to insure it. They ran the numbers, they decided that Florida and California are uninsurable states. Because, it's not just the home damage. It's, if you think about it, when you hear these numbers, when they say billions of losses, blah, blah, blah. Yeah, imagine you're an auto company, you sell auto insurance, and all of a sudden 1 million cars in the same weekend have salt water dumped on them by a hurricane and are totally wrecked. And California just had a hurricane. It was a little one, thank God. But California's had their first hurricane in God knows how long. And that's ocean water dumping all over these properties that are just not made for. The properties, the cars, they don't have the kind of garages. It's not how they drive. It's not how they park their cars. The roads don't stand up. They're made out of dirt and mud, and they fall off the hillside. It's crazy. Houses fall off the hillside in mudslides. There was a theory. Well, there's a thing called a 100-year flood zone. There's no 500-year flood zone. The FEMA, if you're in a 100-year flood zone, which means you have a catastrophic flood every 100 years, FEMA does not require you to buy flood insurance, and that's most of the country is not in a 100-year flood zone. The amount of 100-year flood zone properties has now doubled, and that means that if you're in those zones, you are required by FEMA to purchase flood insurance on your home. But these insurance companies are like, oh, no, because the rates for the flood insurance are completely wrong because we had assumed we'd only have these floods once every 100 years. Now they're pretty much every 10 years. And that completely busts their actuarial tables. But anyway, so good reasons that they were down, good reasons they sold off. They haven't frankly done any better since we bought them. But I like them down here, and we made a couple of plays on the insurance companies to see how they did. Although not as aggressive as we were on the other ones. Here we covered completely. So we have a very small delta between these guys, and we will see how they perform. Then we did Pfizer. That's still available and still crazy cheap. All right. And there we very simply, there we did a covered call because we want to collect the dividends on Pfizer. So we bought 1,000 shares of Pfizer. We sold 10 puts. 37. See, selling 37 puts, 37.50 puts for 525 is what? That means we're netting in for 32.25. That's way down here. It's just not going to happen. Highly, highly unlikely that's going to happen. It didn't happen to them in 2020. So if the whole COVID breakout and everything doesn't knock them down, and again, everything went down with the market. I don't mean that Pfizer particularly should have had a problem because of COVID, but everything went down with the market and there. Oh, and by the way, speaking of insurance, obviously all these people dying of COVID and things like that is not good for insurance either. So we did Pfizer. In Pfizer, we were actually aggressive. We bought 50 longs and we sold 40 shorts. So eventually we'll sell some more calls for income, but let them pop first. What day was this? That was July 21st. So that was around here, and we're just only back to where we were. Here's Qualcomm. That was from July 19th. All right. So don't forget the point is, what were we buying? So given all the stuff I just said we don't buy, what are we buying? We're buying a pharmaceutical company because people need drugs. We bought a communication, internet communication chips and so on and so forth. People need devices. We bought the insurance companies because people need insurance. Down the road, people need insurance. The rates will adjust to be what they make money at, and they'll be fine. IBM, again, that's our AI play. It's the one that, to me, has been ignored in the AI world. They're not zooming up the way other AI companies are, but they're probably the best AI company out there. They don't only have the original AI Watson, which is frankly doing great, and people don't realize it. They have the original AI Watson in whatever variations they call it now, but they also have done a massive amount of research, and they're coming out with chips that run AI systems. So now they're going to be into the chip selling game like NVIDIA, but nobody cares. Nobody pays attention. Paramount content. I think content's really important. I thought Paramount would be bought by now, though, so don't pay attention to me. I can't believe they still traded this price. That just blows my mind. Or they're lower, whatever they are today. This one was a frozen chart. This one's not frozen. They're actually lower. We wanted them at 15.86. They're $1 lower now. It's unbelievable to me. I just cannot believe how low this is, and people need content. I'm waiting for someone to step up. Here's Walgreens. Wow, they got creamed on earnings. Well, I'm sorry, that was yeah, they're no better either. They got killed at the time. We thought that was low enough, but apparently not. It's dropped another $2 since then. Still love them. Yodi does not like them. I like them a lot. Boy, I made my whole case for them here. Big case, a lot of stuff, many words. I really do believe they'll turn it around. Here's Lennar. That was the first real estate company we bought. We just bought the 2 new ones. And Lennar was June 20th. Well, that's what they were on June 20th, actually. I'm sorry. They've actually gone down since then. They were at 121. Now they're at 116. But notice that the spread was pretty conservative. We have a 100-120 spread. We weren't looking for, like I said, if I really want to commit to something, this is what I do. I go deeper in the money, but it was only a $10 spread. So I'm sorry, we paid $10 for a $20 spread. That's where I put my foot down. We didn't quite get 5 back, but we got $4.50 back on each. So we paid net $5.50 for the $20 spreads. And what's that worst case? We own Lennar for 90 bucks. I don't mind owning Lennar for 90 bucks. So there's nothing about this I don't like. If this is the same price or cheaper now, buy it. It's a great trade. Oh, what I said about gold, 1950 is becoming support for gold. And we talked about Barrick Gold. Yep, love them. Always like Barrick Gold. Oh, there it is. So we had a trade for Barrick. No chart though for some. Oh, there it is. And they have not done well either. So what did I say about them? Blah, 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 blah. What's the spread? 15-22 spread. So we bought the 15s, we sold the 22s. And this was June 8th. So that's July, this is June. So they were actually higher. So gold is still a very good buy. Barrick, not the metal gold. And here's Lovesac from June 6th. And well, and that's where they were. This is a frozen chart. That was 24.10. Now they are, ooh, no, that's another frozen chart. That's two frozen charts. 23.10, even cheaper. So another one we can still buy. Anyway, you can always go to these top trades and look, but that's what you do. Is it cheaper now? Did the premise change? Did anything go wrong? These guys sell furniture. They sell cheap. Well, no, it's not cheap. I'm sorry, it's not cheap furniture. It's actually very expensive furniture. But Lazy Boy has done well. Lovesac should do well. They should pull out during the year and have a good end of the year. International Paper. Oh, that's it for that. That's it for that set. So that goes all the way back to June that way. So that's what we have been trading. Those are the kind of stocks we like. Is you know, we're taking staples, right? International Paper, some basic furniture. And the reason I like Lovesac is because they don't have the supply chain issues other furniture companies have, because all their stuff is the same. Like every piece of furniture they have is it's a cube, and you snap it together and assemble it the way you wish, like pattern it the way you want. That's what I like about them. It's not like I have 85 different kinds of couches. It's like, no, we have cubes, and you can configure the cubes 85 different ways and make whatever kind of couch you want. I like that a lot. Oh, plus now they embed a sound system into the couch. That's so cool. So you actually buy, so a couple of the sections that you buy are going to be speaker sections, and they have embedded sound in the thing. So when you're sitting on your couch, it's like right there. It's fantastic. So gold, obviously gold is for its own reasons as inflation hedge. We've got a builder because there's a housing shortage. You know, and although housing demand is down because it's so expensive, people will eventually adjust to inflation. I mean, I remember in the 80s, it was 15% to get a mortgage. People got houses. You just, for what, you know, it's insane, but you know, you can't imagine how somebody's going to buy a house and have a 15% mortgage. People bought the house. Because it's really about whether the rent, and this is a problem, rents are hugely expensive right now. It's really about whether you can afford the rent or the mortgage. And if the mortgage is cheaper than the rent, then you take the rent, then you take the mortgage. It's not complicated. So it just depends on who's pushing ahead at any given time. It doesn't matter what the mortgage is, 15%, but if it's 15% and it ends up being $4,000 a month and your rent is $4,500 a month, then get the hell out of the rent and buy a house, because you'll own the house one day. You know, obviously tax factors and things like that to go into it, but that's the bottom line. You're making a trade-off decision. And the real problem with housing is that it's no longer like a given that your house is going to be worth more when you go to sell it. That's been the real historical problem. Used to be that there was no question in anyone's mind until 2008. But for the 40 years before 2008, there was no question that if you bought a house, you would have more money at the end than you started with. And on that basis, you make your housing decisions. That's no longer true. We could throw a whole generation of people who bought a house and had to sell it for half of what they bought it for. Plus they paid all the taxes and did the maintenance and so on and so forth. That's a bad equation. So we have Pfizer drugs, we have Walgreens drugs, we have Paramount video content, we have Qualcomm chips for all of our devices that watch the video content on. Pfizer, I said, drugs obviously. We have insurance companies, and we have IBM, which is an AI play. That's what we played this quarter. All right, so it's not like there's nothing to play, and it's not like these aren't incredible quality companies. I mean, right here, there's like 6, 7 companies that are fantastic for brand new trades. Still going, because the market has not been performing all that well. How's it doing now? Oops, pull back a little bit, but okay. All right, so that's where we are now. Your computer's running low on storage. Visit storage settings to free some up. Damn it. And you know I won't do that, and the next week I'll complain again. Anyway, thanks for coming, everybody. Appreciate it. Still no questions. Holy cow, I can't believe you guys. All right, great. We are going to wrap it up. Dropbox can't sync until, wow, really cascading failures from this thing. What was I gonna say? All right, anyway, thank you for coming, everybody, and we'll do it again next week, hopefully with some more memory. All right, take care, everyone.